Well, it's 2:30 p.m. and welcome everyone to our webinar on challenges faced by Indian MNCs while managing risk in continental Europe. We'll just wait for another minute or two so that we have more participants. Welcome again, everyone, to the webinar on challenges faced by Indian MNCs while managing risk in continental Europe. I am Pranav Patel. I lead the Indian Client Service Practice at Marsh, India. It's called the ICS practice. We're structured to cater to the needs of Indian MNCs whilst they expand their business to foreign countries. And today we'll be talking about risks in continental Europe in particular. Now, when we see Indian MNCs venturing abroad, they are faced with a diverse risk landscape, very different from what they encounter in India. And they often falter, Indian corporates, when they expand abroad, when they expect similarities in the risk profile between what they see in India and abroad. Clearly, there are some distinct challenges, distinct differences. And the intent was to cover a broad range of issues that Indian corporates will face as they expand abroad, especially in continental Europe. We have an impressive lineup of speakers. So Martin Drux, who's a multinational leader based out of Germany, and he leads the Marsh multinational practice for continental Europe. Martin will talk about a general overview on continental Europe, the key markets, the trends, and the outlook. Kiran Naik, who heads our strategic placement and casualty for continental Europe, Middle East, and Africa, will speak to you about the insurance market and a few updates on some of the developments in continental Europe and some of the key risk issues as well. Paul Knowles, who's our Marsh specialty leader for continental Europe, will speak about some emerging trends in continental Europe with special focus on mergers and acquisitions, cyber, financial lines, and liability insurance. So over to you, Martin.
Thank you, Pranav, and welcome, greetings from continental Europe. So I'm Martin Drux, based in Düsseldorf, Germany, and maybe we can go straight to the first slide. Would like to give you a general overview of continental Europe. So continental Europe currently has, the whole region has about 45 countries, of which Marsh has presences in, mostly own presences in 35 countries. This is the #1 region within Marsh, and almost a quarter of the contribution to our total revenue, with almost 4,000 employees. So if you compare it to India, we have about 800 million population, which is 750 million, so which is a little less than half of India's population, but of course spread over a larger space. It's a fascinating region because you have a relatively small territory. You have an amazing variety, and then you will appreciate it because India, of course, has different regional cultures, languages, and so on. Within continental Europe, there are 31 official languages. So English is almost there's Malta, Gibraltar, but in most countries, English is not the #1 language. In some countries, it's the third or even fourth language. So it's a great variety. Climate-wise, from the very Nordics right now, it never sees any sunlight, very dark and cold, to the very mild climate of the Mediterranean Sea. So that's really the reason what we're talking about. And with that also comes a variety of regulation and different nuances that you really have to keep in mind when investing into Europe. So I would like to give you on the next slide a few key facts we interviewed. Next slide, please. Yeah, so we keep interviewing risk managers around the world, but of course, particularly in this region, and then ask them about, okay, what's very, very high up on their radar. And you wouldn't be surprised that there's a whole variety of risks that you will also, find in the news, and because they are in the news, they are very often make it really to senior management. So here's a quick overview of the 5 top risks that our clients in this region have identified, and they come with a whole subset of other topics. It doesn't come much as a surprise that cyber is very high up there. Cyber has been in everybody's mind for a couple of years. We're trying to, of course, model insurance and risk management solutions around it. During the pandemic, the cyber risk increased due to most colleagues working remotely, especially in the office environment, and thereby making, of course, the protection of data and systems, more difficult. But at the same time, we see an increase of e-commerce, more online collaborative tools, with everything around the digital transformation, which brings great progress. There is also an increased risk of vulnerability around that. The issue of political risk is clearly a global one, but even within Europe, that has always been kind of like felt like for many years kind of like protected from a lot of issues, sees things affecting everyday life. So you saw the introduction of trade wars, also long-standing partners all of a sudden changing gears, not being as reliable anymore. We have on the eastern border, problems or challenges around migration, all kinds of things, and of course Brexit, which we'll cover a little bit later in this conversation. People risk, another broad topic, one issue that increased during the pandemic is the whole issue of mental health. So people had to go into isolation, fear about their existence, about their health, about their loved ones. So there is still a risk that we don't really know how large it is, but it's clearly out there where we need to pay attention to. But at the same time, we see a big war over talent and retaining talent, attracting talent. This is really a major issue. And with that, linked to that, we see migration, which is both a challenge and an opportunity, because there is in certain industries, it's very difficult to find qualified labor, and so that creates a big challenge for many employers. Climate change, of course, has been in the news for a long time now. This year, so forest fires. Here in Germany, not far away from where I live, there was a massive, unexpected, and never seen before flood, where small creeks, small rivers really, became big rivers, destroying whole cities. Everything, a massive rain that probably can be compared to your monsoon. I mean, it's really something that we have never experienced here in Central Europe. So that's obviously the same with rising ocean levels and other phenomena. It's really a major risk and threat. And then supply chain continues. I mean, it's not really a new one, but it's really something that continues high in the agenda. Again, what was in the news this year was, of course, the Evergreen incident in the Suez Canal, but there is currently there are issues around semiconductor products, shortages around that. So a whole range of things that shows again how vulnerable the supply chain and therefore production can be. So there are various solutions to cover it. Of course, traditional insurance is a solution, but we see more and more companies going into taking a look at alternative risk transfer, captives, protected sales, or even parametric solutions. Okay. Then I would like to share on the next slide, I would like to share with you a couple of regulations that are specific to Europe. So the GDPR, the Brexit and ESG is something that I would like to talk about a little bit more. So the GDPR is really the General Data Protection Regulation, which is was introduced in the European Union in 2018, and it's one of the strictest data protection laws in the world. Really, any risk, any exposure linked to Europe, even if it's located in India or otherwise, would be covered under that law. And companies like Marsh McLennan had to go very deeply into our own processes, protocols, tools, how we share, how we collect data, how we store data and delete it, how we work with external partners. This has to be it is highly regulated and has to be well documented. There have to be very solid sound proof mechanisms in place. Otherwise, a risk for very strong penalties or even worse. Then we had the Brexit. So that's been, it was, I think, voted on 2016, I believe, and it's been everybody's mind. So this became reality beginning of the year, and of course, know that the Great Britain decided to leave the European Union and become independent of this union. And from an insurance perspective, this was all well prepared. We had a long time. Insurers had a long time to really look into this. What does it mean? It's not really, from an insurance point of view, a massive deal. So the UK are just another country now, no longer part of the European Union. They cannot be covered under an FOS policy in a classical sense, but at the same time, it's non-admitted insurance for the UK is permitted. You can also just simply buy local insurance if your risk is located in the UK, and the other way around. If you had coverages out of the UK, you cannot have a FOS policy anymore. And but at the same time, any other country in the European Union could talk about that. So FOS, very briefly, freedom of services policy, really a specific thing to the European Union, where one policy can cover the entire region as long as the risks are being located in the European Union. And last but not least, one topic that is becoming very, very big, and I think I think Kieran might also touch a little bit about it from the underwriting or market perspective, is ESG, environmental, social, and governance reporting of companies. So there is more and more scrutiny on the sustainability of companies, how they address all issues related to the environment, to social matters, and to regulatory governance. So that is something that is coming very high up on the agenda of all companies. Not everything is related, of course, to insurance, but what we see, for example, is that more and more insurers, maybe as an excuse, maybe because of the scrutiny that they are getting, are withdrawing from certain risks, especially if it's linked to dirty energy, so to coal mining, what have you. So that is, in a nutshell, the overview of the Europe as a region, the top risks that our risk managers are seeing, and the top regulations that are currently keeping everybody talking. Under these, you will also see a variety of local regulations and things that make it important that when you structure a program, that you are aware of certain tariff markets, certain mandatory coverages. So again, it's a region with 45 countries, and only half of it is under part of the European Union. The other part is not. The other half is not part of it, and all of this is really makes it an interesting and vibrant place to do business in. But it needs a good good planning, good advice upfront. And with that, I would like to hand over to my colleague, Kieran Nye, who is really more focused on the broking side and the insurance market. And he would like to give you an update on what he sees currently in the insurance market. Kieran.
Thank you, Martin, and welcome everyone. And I was about to say good morning, everyone, but realizing that most of the people on this call or this meeting are based in Asia or India. So good afternoon to everyone. My name is Kieran Nye, as Martin said. I'm based in London, but very much working within Continental Europe, Middle East and Africa. Today, I just want to give you a quick, brief overview of the trends that we're seeing in the Continental European region. Give an overview from my perspective on the key themes that are driving these markets and these trends, what to expect for 2022, and ways in which you should best manage your renewals in 2022. Next slide, please. Thank you, Barrett. So this chart comes from the General Market Insurance Index prepared by Marsh, based upon the clients that they have within the region. It's actually a global index, but this slide in particular refers to the rates that we've seen. As you can see, going back now to Q3 2017, although it does go back further than that. And as you can see, the trends as per quarter rate increases we see. This is very much a general slide. So what we're seeing here is that if you look at Q3 for 2021, you see the average rate increases of 10%, which has actually come down from the previous quarter, with 15% rise that we're seeing globally. And what's important actually is this continues the longest stretch of increases we've seen since the inception of our index in 2012. So Q3 2021 average rate increases of 10%. This compares in Asia, the composite insurer pricing change was slightly less at 6% in Q3. Pricing increases across most regions decelerated due to slower rate of increases, mainly based around property insurance and D&O, other than in the US, where property and financial and professional lines pricing did increase. Cyber, which Paul Knowles will come to later, continues to dominate environment, and certainly with price increases significant in this quarter due to the increased frequency and severity of losses. So what you see here is the pattern for Continental Europe, but as I said, there are rate variances, but this general pattern pertains to the global basis. Next slide, please, Barrett. So in this slide, I just want to go through breaking down that general average into property, casualty, and financial lines. So starting with property increases of 12% we saw in the last quarter. So rates have generally stabilized, although the increases remain common across all sectors, but predominantly for catastrophe exposed risks. However, the rate increases were at slightly reduced level compared to the prior quarters. This is mainly due to competition for new business increasing amongst the domestic European carriers. However, insurers continue with strict underwriting controls, particularly for large, complex multinational clients. But those with better loss history that demonstrate good controls, they attract more favorable terms. The significant losses experienced during 2021, Martin touched on them, such as the European floods, are likely to destabilize the markets in the near term, particularly in those areas which are affected. So on the property terms, those areas, so Germany, Belgium, Netherlands. Changes in wordings and an aggressive approach by carriers remains a challenge, and they continue to seek to apply exclusions, particularly for communicable diseases and cyber. From a casualty point of view, insurance prices in Q3 2021 increased 5%, so far less than property. However, the 9th consecutive quarterly increases, so there's the compound effect. Excess casualty and US exposed placements continue to be the most challenging sectors, with most countries in the region experiences pricing increases in the single digits, but some, for most distressed industries, 20% plus. A lot of insurers are expressing particular concerns around social inflation, which we'll come to later, and US auto exposure. Some clients also experiencing increases in workers' compensation, and that's generally due to limited capacity. Turning finally to financial lines, saw an average increase of 14%. Some stability in D&O market, especially compared to prior quarters in the prior year. And this is largely driven by, I guess, prior quarter and prior year increases, but also additional competition coming back into the market with capacity. However, major D&O programs in distressed sectors with US exposures continue to affect pricing, as Paul, again, will come to that later on. Average pricing increases for financial lines, professional liability, generally range from 5% to 20% across the region. However, as I said before, sizable rate increases continue for cyber, with carriers reducing exposure with increases of 60% and greater, a common trend. This isn't expected to reduce next year. We see that as a continuing difficult area and one that we should be addressing. Next slide, please, Bharat. So this slide, I just wanted to touch here on the themes driving the reinsurance and therefore also the insurance market. Again, I mean, these themes, these issues are common globally. So yes, they're relevant for Europe, but also relevant global. But, you know, talking to a multinational community here, you know, I think they're very, very relevant. So the macroeconomic uncertainty, yes, the economic picture continues to improve globally, with fiscal support adding to the economic recovery, but inflation risk is still growing. Low investment yields and inflation and other longer term risks affecting insurers' profitability. Loss activity. COVID-19 still dominates, one could argue, the social, political, but also the insurance agenda. At the moment, expected losses of $40 to $50 billion, but with upper figures around $100 billion. So that's quite a large range, obviously, which demonstrates and shows the uncertainty that still exists and therefore has an impact on the pricing that insurers are putting forward, especially disputes around BI exclusions and how they might impact profitability. So business interruption exclusions. And as I say, the impact on insurers vary from insurer to insurer, but it remains very much in the forefront of their minds, and also looking at what the next big loss, what the next big pandemic might be. Rising burden of climate change, looking to the future, we'll come to that later, and the increasing loss trends for the insurance industry. Catastrophe losses remain very prevalent. We've talked about Europe, but also in the US and globally. And also secondary perils for forecasts. Secondary perils like flood, fire, cyclone is a major concern. Wildfires in the US, wildfires in Southern Europe as well, something that we've not seen so prevalent before, but it's becoming an issue for reinsurers, which will become an issue for insurers, so something to bear in mind. The Burton flood event earlier in the year has severely, first half of the year, I think insurers were making profits, which affect the rates. However, it's interesting to see how that will affect the short-term climate and the short-term rating that insurers put, especially on the property lines. And then from a casualty point of view, social inflation continues to dominate. Class actions, increased litigation, court awards. It's a major concern for insurers. Pressures on profitability. We know financial year 2020 returns took a knock from COVID-19 losses. And as I said, still incredible amounts of uncertainty there. Lower investment yields, lower investment income. Reinsurers, catastrophe losses have trended upwards. Reserve releases are in decline. Additional pressure on insurers. And then evolving risks. Insurers are looking, what's the next big thing? Martin touched on ESG, climate change, secondary perils. Insurers are frantically trying to recalibrate their risk models. Secondary perils in particular, something that they have never modeled before. The models they have are very immature at trying to estimate exactly what the losses are going to be. We've all seen this, the shift from tangible, very much tangible assets, something that insurers are used to underwriting, have modeled, to more intangible assets, cyber, intangible risks that haven't been modeled before. And we're seeing increased movement from clients into more intangible risks and the effect of the losses there, therefore. and digital catastrophes. That said, that's kind of a doom and gloom picture in terms of the pressures upon reinsurance, but Solvency II ratios have remained resilient and remain resilient. Capital in the sector is strong and stable. There's more capacity coming to the market. And as we said, reinsurers' risk appetites are evolving. So from a pricing point of view, premium growth over the year has had positive impacts on trends. And the mid-year placements, what we see in mid-year Q3 placements, we've seen a deceleration of rate. Yes, moderate increases, but certainly far less than last year. So, certainly capital remains strong, capacity remains there. Difficult sectors will remain difficult sectors, but there's some positive signs on the horizon. I think a good summary would be that risk appetites are evolving, but definitely insurers are recalibrating their risk models for secondary perils and those risks that they're unforeseen perils that they're trying to predict in the future. Next slide, please. All right. So here on this slide, we talk about the key themes ahead of 2022 renewals. I've touched on most of these before. I think the good news is that rates on the reinsurance side have increased less than we've seen on the commercial space, and that should therefore filter through. There is a lot of capital into market, as I said, which has helped contained increases, and it'll be interesting to see how this trend continues in the future. New markets are stepping up and are now looking at Europe. More and more capital coming to Europe, where there is more price adequacy in the past because of the previous rate increases, and therefore it's more attractive. This additional supply should also assist in containing price increases. But just looking at this slide, much to which I touched on before, as I say, COVID-19 still dominates the horizon to a certain extent, increasing communicable disease language. There is little commonality in the market, something that we're trying to wrestle with. Cyber coverage, we'll come to later, but more and more exclusions coming into general casualty, property wordings. A lot of focus on natural perils, which we talked about, climate change, how that affects definitions, macro impacts of low interest rates, inflationary environment, ESG and environmental social governance that Mark talked about. And really, it's the insurers are trying to, what's the next big unknown? COVID-19 obviously caught the market cold, and they're trying to predict what the next big unknown is in a very, very volatile and changing world. Next slide, please, Barrett. So what to expect? I've put up here a couple of recent articles, from the ratings companies, from Guy Carpenter, Marsh's Reinsurance broking arm, Business Insurance, and Swiss Re. And in short, you'll see the areas that I've underlined there. Ever higher, the prediction from Swiss Re, well, they would, wouldn't they? Ever higher catastrophe losses and focus on secondary perils, windstorm, wildfire, how they model them, what that means to overall ratings. Again, Fitch talking about the rating agency talking about heightened catastrophe losses, lower interest rate, mounting inflationary concern. But then, flip side saying current pricing is still inadequate in the face of rising catastrophes. So, it's just one to watch. Tighter terms and conditions, and as the Guy Carpenter comments there, convergence of tangible and intangible assets. So what to expect? Property side, we've seen some stability in the market. General expectations are that increases this year will not happen again. However, there remains a lot of uncertainty with carriers who could push the rates up again, but probably less than last year. In general, when I look at renewals ahead of Q4, when I speak to the offices around the region, capacity doesn't seem to be a major issue for most countries, but those difficult sectors in property, waste management, for example, remains an issue. And so you will always get those pockets where there are capacity and pricing issues. But in general, from what I'm hearing is capacity is not a major issue and their concern. Obviously, we've seen the fires in Greece and Turkey, the flooding in Central Europe. They will hit the good results that the carriers had in the first half. What will that do? What will that do to rates next year? So risk quality, risk prevention is very important. Carriers are asking for more. cat losses, around cat exposures, BI limits, for example. So one to watch in terms of the information that we're providing to insurers. On the liability side, increases are still generally contained. We're still seeing mid to high single digits. We haven't made the double digits. Will that come? But the market remains challenging, as I said, in certain areas. Automotive, pharmaceutical clients with significant US exposures, still remain challenging area. Non-core casualty covers, product recall, financial loss, professional indemnity, often historically added to global casualty policies, often thrown in, often not charged for. We're seeing increasing signs of them being stripped out. So, the message here is, make sure that you're accessing, speaking to Marsh, speaking to your broker about how those master policies can be supplemented. Look at some of the niche lines, the expertise that we have in some of those areas. More communicable disease and cyber exclusions I've touched on. But that said, markets are still showing growth appetite, especially for new business, and that increases competition, which has a positive effect on the rates. So in summary, climate change and continued uncertainty around natural catastrophe dominates the environment, especially secondary perils. And the next big unknown, what is that? As such, caution should be exercised, but on the flip side, capacity remains strong. New 2021 entrants are more likely to follow. This will serve to bring much needed competition, which should help to contain rate increases. Next slide, please, Bharat. So I wanted to just include this slide from my perspective, which is how best should you, in the face of the uncertainty, the uncertain world, some of the challenges that face insurers, how best to manage insurers. So I would suggest work with Marsh, work with your broker to put in place robust placement strategies. Make sure we're accessing the market early, engaging with the market early. Good quality data and underwriting information. Work with Marsh, work with the brokers to understand what are the areas, what are the pertinent areas that the insurers can look for, how to get your risk prioritized, how to have really strong, good engagement with the market. Work with your historic markets, your key partner markets. I also say this to clients all the time. Make sure that Marsh are accessing the global marketplace. We see more capacity coming to continental Europe, but make sure that we're accessing, the Asian market, the London market, the US market, to either ratify what you're getting and the renewal terms you're getting locally, or to provide competition on much needed competition in those markets. Have a plan B. Make sure you've got placement options. Don't rely on what you've got at the moment, even if it's just to put pressure to help keep rates in check. And then Martin touched on his slides. Look, for more difficult to place risk, ones that the market cannot provide terms for in an economic way, or the coverage just isn't there, look at alternative risk financing strategies. Captives, for example, we're seeing increasing pressure for insureds to increase retentions and increase deductibles, certainly for difficult risks. And also the captive becomes quite an efficient vehicle for incubating new exposures, but also putting competition on your insurers, taking premium out of the market. So those will be my advices around how to manage the market in 2022. But at this point, I'd like to pass across to Paul Knowles, who will talk more around the specialty trends as it pertains to the region. Paul, over to you.
Thanks, Kieran, and good afternoon, everyone. I'm going to sort of build on some of the themes that both Martin and Kieran have talked about today when I look at the specialty world. I think when you look at continental Europe, you do need to understand the diversity there in terms of culture and stages of development. As Martin talked about, there's over sort of 40 countries in continental Europe, and within the Marsh sort of definition of continental Europe, we have 35 countries. And those countries are at different stages of development with different risks, different economic drivers. We can go from the sort of extremes of Russia and Kazakhstan to the more sort of European, sort of Western European countries of France, Germany, down to the more emerging sort of economies of Eastern Europe and the Mediterranean sort of Turkey, and then to the sort of technological leading countries like Israel. So there's a lot of diversity there, and with that becomes different opportunities and different challenges. If we go on to the next slide, just to sort of frame it, the specialty world in which sort of certainly I operate and within continental Europe cuts across 7 areas. Some of these are more product biased, some of them are more industry biased. But as I said, they will have different sort of requirements in different parts of continental Europe and will create different opportunities as well as different risks. So just quickly sort of introducing you to the specialty world. If I start at the top of the circle there and look at our PEMA world, which is private equity mergers and acquisitions for us. We then cover the aviation world, which sort of covers both airlines, aviation manufacturers, as well as airports, and the space and satellite world. We have construction, looking at contractors and both the single project risks. We have energy and power, which includes oil and gas, as well as power generation and renewable energy. We have marine and cargo, covering ships, ports, terminals, shipbuilding, as well as logistics. We have FINPRO, which covers our main financial lines, product areas, as well as some of our financial industries like financial institutions. We have our credit specialties business, which covers our trade credit, our political risks, as well as our surety. So those are the sort of 7 areas. I'm going to, in the next sort of 5 minutes, take you through some of the trends we're seeing this year and into next year in those 7 areas and how they could potentially impact yourself when you're looking at continental Europe from a risk perspective. So I'll first deal with PEMA, the private equities mergers and acquisitions. We have seen a significant acceleration in M&A activity over the last 18 months. When Europe went into its first sort of period of lockdown, really starting in February, 18 months ago, we saw a real sort of stop in M&A activity. But post that period, we've seen an acceleration, which has been sort of driven quite to a large extent by the private equity markets. Those private equity funds, which both European and globally based, are sitting on significant amounts of capital. I think the latest estimate in respect to the dry powder funds that those private equity players have got to distribute is something in excess of $2.5 trillion. And we're seeing Europe as a very attractive area for that M&A activity. So we're seeing a heavy deal flow in terms of M&A in Europe, and quite diverse in terms of its target areas. We're seeing increased M&A activity in Eastern Europe, and for example, a lot of technology M&A in places like Israel. Within that world, we're seeing an increased utilization of the products there in terms of warranty and indemnity insurance to facilitate those transactions, as well as an increasing involvement in the more esoteric risk areas of tax and contingency. So the PEMA world is definitely one which has been seeing a lot of activity. Moving into the FINPRO world, as Kieran sort of talked about, it has been a challenging 24 months for FINPRO, both in terms of price and capacity. The reality is most of those losses, most of the sort of pressure is being driven by losses outside of continental Europe. Continental Europe remains a relatively stable legislative environment for directors and officers risks and other FINPRO areas, but it is not sort of immune to those sorts of losses. And there have been some very high profile ones, probably the German automobile industry, probably, at the highlight of sort of the global media. But overall, Europe has been relatively stable from a loss perspective for the FINPRO world, but it's not been immune to the rating challenges of the market. As Kieran said, we're starting to see a little bit of capacity coming back into the market, a little bit of moderation in price increases, but it certainly remains a very challenging area. One of the things that we're also seeing picking up in the FINPRO world is the increase utilization of IPO and SPACs in order to facilitate M&A transactions. Again, sort of linking back to the PEMA world and the increase we've seen there, we're definitely seeing a growth in the clients utilizing the FINPRO products to facilitate either restructuring companies or sort of facilitating merger and acquisition activity. One of the key areas we're dealing with at the moment is cyber. Again, Kieran referenced the challenges we've had in that space, driven by the increases of losses, fundamentally in the ransomware area. The European markets have not been immune to that, and we've certainly seen an increase in those losses coming through. Quite clearly, with the increased utilization of working from home during the COVID crisis, it's thrown the need and importance of cyber even further up the agendas of most of the European boards. The challenges we're having in the cyber world will remain, and quite clearly, there's a need to demonstrate a high degree of risk management and loss control within that area in order to deliver the right sorts of deals. Certainly, we are working, our placement teams and our advisory teams are working with clients across a lot of risk areas in order to be able to deliver meaningful information to the underwriters to really be able to understand the risk profiles of our clients. If I look at the credit specialties area, which is, as I said, covers both trade credit as well as political risk and surety, we were anticipating a significant impact during the COVID crisis on trade credit, anticipating a lot of losses coming through. The reality across continental Europe, governments responded incredibly proactively in respect of that risk area, and were able to put in place government schemes which protected an awful lot of clients. In addition to protecting clients, that also protected the insurance market. So the trade credit insurance market remains very robust across the region, and the ability to sort of arrange trade credit insurance remains a very viable option for lots of clients trading on a multinational basis or even solely within a single geography. What we have seen is an increased utilization of surety, both from a construction and a commercial surety perspective, as people have, or companies have sought to balance the use of their banking facilities and using sort of the insurance surety world to act as an additional line of credit to facilitate their actions. Also, we're seeing an increase in the utilization of political risk and structured credit solutions. Although it's fair to say at the moment, the banks, although sort of looking at and sort of pricing political risk and structured credit solutions, aren't buying as much as they have done historically. And I think that's more of a case of the financial institutions going through a process of assessing their own sort of balance sheets and lending process. But we anticipate seeing a continued uptick in utilization of structured credit and political risks to facilitate, again, corporate deal transactions. So if we move to the next slide, when we look at energy and power, it's a very diverse area. We're certainly, and again, going back to Kieran's issue or topic around ESG, we're seeing an acceleration towards renewable energy. Certainly coming out of the COVID crisis, one of the big areas of government fiscal stimulus has been into the acceleration of the renewable energy shift, and that's in the majority of countries. We have to say, as again, given the diversity of continental Europe, we still have a lot of countries heavily dependent on coal. Countries like Russia, Kazakhstan, heavily dependent on hydrocarbons and oil and gas. So there remains a significant number of hydrocarbon-based risks. and there remains significant challenges around finding insurable solutions for those risks. And that's one of the sort of challenges we have to face. But certainly the whole energy transition, and now I'm including within that the utilization and development of hydrogen solutions as well, is becoming more and more important across the region. And even countries with a relative surplus of power and energy are looking at how they accelerate their shift to more greener solutions. Moving now onto the construction sector. Again, construction was hit incredibly badly during the COVID crisis, but rebounded very quickly. Again, sort of driven by government stimulus, as the governments around continental Europe, in order to provide a kickstart to the economies coming out of that first wave of the COVID crisis, applied a significant amount of fiscal stimulus, which is still flowing through into the economies, and a lot of that came through social infrastructure. One of the challenges that we have within the construction sector, which is a global issue as well as a European issue, is the supply chain. And certainly there are pressures there in terms of pricing within construction contracts. Europe has some of the largest global contractors in the world, so they operate around the world, and they're certainly having to deal with challenges, not just from a material perspective, but also from a personnel perspective. In the marine and cargo world, we have seen an extraordinary increase in focus around the shipping industry, with cargo rates now at their highest for a long time, which has increased demand in the shipping world. The marine world is not immune to the global phenomena around ESG. And one of the big areas that we will be seeing as we go forward is the movement towards the refurbishment of ships in order to create more environmentally friendly transport systems. As well as the general increase in shipping conditions, we're also seeing an acceleration in shipbuilding opportunities. Quite strangely, one of the biggest areas of increases is for the super yachts, as an acceleration in the world's billionaires is they're now looking for their own ships in order to be able to find safe havens during crisis like we're living through at the moment. So the shipping yards are now very busy with orders for new super yachts. I'm not sure if anyone on this call will be ordering one, but if you are, you may need to wait a while. We're also seeing, obviously, a growth in logistics as an important area, with a shift in supply chains driven by the impact of the COVID crisis. We've seen, companies now trying to focus on creating shorter supply chains. The just-in-time process that we've had for a long period of time is now being challenged, given the impact, as Martin referenced, in terms of shortage in microchips, as well as other key commodity areas. So there's a big focus on creating the right logistics and how the cargo insurance world can help to manage those risks. And finally, aviation, which was probably the most severely impacted of areas. We are seeing a significant bounce back in travel. Obviously, the world is not through the COVID crisis. In Europe, we're going back into lockdowns in a number of countries as the COVID cases increase significantly. So how the aviation market and world continues through this current wave of the crisis will be interesting to see. But certainly globally, we're seeing an increase in aviation activity. And that's not just airlines. We're also seeing an uptick in the space world as well, as sort of more satellite launches are moving back to their pre-planned or pre-COVID planned launch sequences. So there's a lot going on across the specialty world, and lots of risks to manage. But as Kieran sort of emphasized, the insurance market is moving from a much sort of more balanced place than it was 12 months ago in continental Europe. So offers opportunities for the right deals to be structured at the right price and right coverage, but not without significant amounts of thought and planning. That was all I wanted to say at this stage, Barrett, and we're now, I think, happy to take any questions.
Thanks a lot, Martin, Kieran, and Paul, for this insightful presentation. I'm pretty sure our audience must have had a great insight into the continental Europe market. We have a couple of questions coming up. The first question, Martin, if I may post it to you. The question talks about freedom of services. You mentioned about freedom of services. So can you elaborate a bit more on the freedom of services model, what is running in the continental Europe market? And can you also talk about a couple of advantages and disadvantages of using FOS?
Sure, certainly. So yeah, I mentioned earlier, so the FOS freedom of services policy concept is really some particular to the European Union, not to all of continental Europe, whereby you can have one policy issued within one member state that covers the entire European Union. So so let's say you have a factory in Germany, you can cover all your other plants and operations in Spain and Belgium, Italy, what have you. So that's a great advantage, especially if you think about the highly regulated market that you in India know. It makes things very easy on the surface. So it's basically non-admitted insurance across this territory. So the advantages are obvious. So oftentimes, if you issue local policies, insurers will ask for a minimum premium around the world. If you so that would then no longer be necessary. You still have to pay the taxes to that premium allocation part that goes into the various countries, but no more minimum policies necessary. The other part is, of course, a very harmonized wording that actually one wording that applies to the entire region. So from a administration point of view, in addition to potential cost reduction, that is really why people really like those policies. Now there are some. We talked about the diversity in regulation. So one of the big things, of course, when it comes to claim, it can get tricky. So especially if you think about liability, you have completely different legal systems in various countries, different languages. So it's there might be some ambiguity or other things that make it tricky to get claims handled. So especially with liability, we advise against FOS solutions, especially if you have more complex exposures, more complex risk across the European Union. So that's really the one part. Also, I would not necessarily, and I'm not saying that because I'm Marsh, but wouldn't necessarily translate it into no need for a local broker either, because there might be still a need for consultancy around certain things. So that's something that should be seen separately. So of course, you could say, okay, let's save the minimum premium, let's save the broker appointment. I would, in both cases, really make an assessment on where it makes sense, where it doesn't make sense. And last but not least, you have cases, things like consortia, for instance, natural catastrophe, tariff markets, and so on, that need to be built in, and that's in Spain. So it's really something that should be well thought through before you make that decision.
Thanks a lot, Martin. Thanks a lot for your insights. We have another question, Paul, in case if you can take this. It talks about non-damage business interruption. So COVID definitely has exposed us to non-damage BI. Can you share a couple of market practices and how the market is maturing for this particular risk for future?
Yeah, no, sure, Brad. And definitely sort of COVID has thrown into the spotlight the contingent business interruption or non-damage BI I suppose interestingly, we haven't seen a huge amount of claims for that within continental Europe, certainly probably less so than we've seen in the UK or countries like Australia, but it has sort of focused the insurers' mind around the exposure. And now in order to get sufficient cover for contingent BI or non-damage, you need to be able to demonstrate clear risk management and clear risk information to the underwriters, the ability to get automatic sort of limits under policies. I wouldn't say are a thing of the past, but are definitely much more challenging. So, for clients who are looking for that type of cover, then we need to work with them quite early to identify the exposures that are there and give that sort of transparency and clarity to the underwriters. Otherwise, it's a very difficult risk to provide meaningful cover and capacity for clients.
Thanks a lot, Paul. Thanks for your inputs on this particular question. We have another question coming up on NatCat. So NatCat had been growing over the last couple of years. The question is, can Marsh help clients in understanding the risk and also help with statistically calculated suggestions? Paul, Kiran, in case if you want to pick up this question.
Yeah, no, I'll start and then Kieran can sort of fill in. But certainly, we're very able in our risk advisory teams, working with our placement teams to provide clients with input around natural catastrophes and the sort of relative exposure across continental Europe, which has a variety of natural catastrophe exposures, from wind to rain to sort of earthquake and everything in between. But as Kieran sort of said, and he might want to sort of build on, one of the key things we're seeing is now the sort of secondary risks and risks that we hadn't seen before, like the wildfires and even the German flooding that Martin referenced. So it's probably an area where we can definitely provide advice, but there's a lot of work that needs to be done. I don't know, Kieran, if you want to add anything.
No, I'd agree 100%, Paul. There is a lot of work to be done. And what we're seeing is, obviously, and I touched upon it in the section of presentation I gave, is that insurers are pricing or trying to price for this. So I think it's important that insureds evaluate the limits they're buying. So do that analysis, get the advisory from Marsh or whomever else to justify their limits they're buying, but also to understand their exposure so it can be articulated as accurately as possible to insurers. So one, they're not paying for what they don't need, but also what they are paying for is adequately understood. And we say, as an example, we have a practice looking at BI exposure. So we have a couple of experts which can visit exposures and validate and look at their BI exposures. So exposures that perhaps haven't been mapped and haven't been challenged, definitely do that and do not buy for coverage you don't need, because it will be expensive. So that would be my advice. But in short, the short answer to the question is yes. There's a number of ways which Marsh can help and speak to your client executive, your placement broker, and increasingly Marsh advisory.
Thanks a lot, Paul. Thanks a lot, Kiran. Pranav, you would want to add anything on this particular answer from an Indian context? Any tools which can be used for our clients?
Yeah, clearly, I'd say NatCat is an area of concern, and as we're seeing larger losses in this space, I see tools being formed, national tools in the times to come, which will keep a tab and control over the losses faced by insurers, and I think that's imminent considering the recent stated process.
Thanks a lot, Pranav. Thanks. Kiran, I have another question on ESG. Now, ESG, of course, we were talking about in the presentation, also is becoming a serious concern across the globe. European Union Sustainable Finance Disclosure Regulation has also come into play since March. Can you throw some light on this particular regulation and probably, how the insurance market is supporting clients?
Yes, of course, Barra. And I also note that Diana's asked 2 questions.
Yes.
Hi, Diana. So I think this will address your second question as well. I mean, look, we've talked about it. In short, ESG is extremely topical, but it's a moving feast. I think to say that the insurance market is sophisticated in how they deal with it would be telling lies. Yes, carriers have jumped on the bandwagon and are starting to adopt their own measures. But I think it's also fair to say that very few have, well, they haven't clarified exactly what the impact will be on clients and their support. So yes, looking forward, it will become, yes, insurers are talking about it, the community talking about it. You know, a few of them, you know, including Marsh, you know, who can help clients, you know, launching index scorecards, so looking at trying to index the ESG ratings, looking at trying to index their ESG maturity, if you like, and these to be completed by the clients. And these scorecards will help support clients in highlighting the areas that require focus and attention, as well as being used by insurers in the future to assess the underwriting exposure. And in theory, although not yet, these will have ramifications on premium rating. As I said, very much still in development, although a few are ahead of the game than others, and engaging with the client. So, you know, very few have actually proposed a solution or clarified the impact, but it's coming. I'd say work with Marsh. We have a big team. We have an ESG a global leader, which we can engage you with. But, you know, based on my experiences, you know, those carriers that have started including ESG criteria have done so at a relatively high level. You know, and so it tends to be an ad hoc questionnaire. Questions are evaluated often discretionally, and if it's a low outcome, carriers tend to punish the client or don't offer terms rather than look at rates. But this is still in development, you know, as I said. It's more, I would say at the moment, it's more of an issue, and maybe Paul wants to touch on that in the credit specialist area in the D&O, where it becomes a reputational issue, and I think that it is much more of an issue there. But generally, yes, it's coming. It's difficult to quantify at the moment, but yeah, work with Marsh, work with scorecards, and I think in the future it become absolutely a selectivity issue. But Paul, I don't know if you want to touch on the D&O specifically in credit specialties. So I know there's much more of an attention on when it comes to proposal forms and that to insurers.
Yeah, there is, Kieran. But probably I think we've run out of time, haven't we?
Yeah. Yeah, I think we'll just take the last question, Martin, in case if you want to pick up this question with regards to global programs which are arranged out of Asia, including EU assets. Have you seen any case where EU risk was carved out? You know, if you can answer this question, we'll take this last question.
Okay, thank you. Yeah, so what I see is that particularly from Japanese and Korean companies, that they have a more regional approach to structuring programs. So I wouldn't say that they exclusively carve out Europe. I haven't seen that, but standalone European programs are actually more common than uncommon for that case. But this is not a reaction to a certain market. It is more the traditional way of arranging global programs, which I would say are still in the developing stages out of most Asian countries, rather than, you know, US programs or European programs that are probably already more established. Hope that answers Diana's question.
Thanks a lot, Martin.
So Bharat, just quickly for me, I've seen more requests asking for that, which would suggest to me that perhaps the Asian insurers are facing those risks at a higher level. So we've seen a lot. I certainly have seen some requests. But back to Martin's point, I see very few where it's caused the breakup of those global programs at the moment.
Yeah. So our clients can also look at the regional programs in case if they want to consider that. Yeah.
Sure.
So thanks a lot to everyone. Thanks a lot to our participants and our audience, everyone, for joining us. And thanks to our Martin, Paul, Kiran, and Pranav for joining us for this particular event. Thanks a lot. We'll be sharing the link of the recording, and we'll be sharing the presentation with all the participants. Please feel free to come back to us in case if you have any questions, shoot off us an email and we'll come back to you. Thanks a lot.
Take care, everyone.
Goodbye.
Thank you. Bye.